What are the best stocks for calendar spread scalping? If you are curious about which stocks work best for calendar spread scalping, you are in the right place. Let's break down the key factors to consider when selecting stocks for this strategy. Calendar spread scalping involves selling a near-term option while buying a longer-term option with the same strike price. The aim is to profit from time decay and changes in implied volatility. First, look for stocks with high liquidity and tight bid-ask spreads. This is essential because calendar spread scalping requires quick execution and frequent adjustments. Stocks with tight bid-ask spreads help reduce trading costs, which is vital when aiming for small profits. Next, consider stocks with moderate to high implied volatility. These stocks provide richer option premiums, enhancing potential gains from calendar spreads. A volatility skew, where near-term options have different implied volatility levels compared to longer-term options, can create opportunities for profit. Stable or predictable price movement is another important factor. Calendar spreads tend to perform best when the underlying stock price remains relatively stable or moves within a predictable range. This stability allows the short-term option to decay in value faster while the longer-term option retains value. Additionally, stocks with upcoming known events can be great candidates for calendar spread scalping. Events like earnings announcements or product launches often lead to spikes in implied volatility. Traders can exploit these situations by scalping calendar spreads around these events, benefiting from the expected volatility changes. Now let's look at some examples of suitable stocks. Large-cap stocks like Apple, Microsoft, Amazon, and Tesla have liquid options markets and often show predictable volatility patterns. These stocks are frequently traded and can be ideal for calendar spread scalping. Energy sector stocks, such as ExxonMobil, also make good candidates. They often exhibit stable price ranges and have liquid options, making them suitable for this strategy. Biotech and pharmaceutical companies with upcoming FDA approval dates can be particularly interesting. These stocks often see elevated implied volatility before announcements, creating opportunities for traders to capitalize on volatility changes. When applying this strategy, scalpers typically enter calendar spreads when the short-term option premium is relatively high, while the long-term option is cheaper. The goal is to capture the premium decay of the near-term option. Ideally, the stock price should stay near the strike price until the short-term option expires worthless. This allows traders to keep the premium collected while retaining the longer-term option for future price moves. Risk management is also important. Sharp price moves or unexpected volatility spikes can impact profitability. Scalpers often use tight stop-loss orders and careful position sizing to manage risk effectively. In summary, the best stocks for calendar spread scalping are those with liquid options markets, moderate to high implied volatility, stable price behavior, and upcoming events that influence volatility. Large-cap tech stocks, energy companies, and biotech firms with scheduled announcements are excellent choices for this strategy. By focusing on these characteristics, traders can efficiently exploit time decay and volatility changes in their options trading.